This video is brought to you by the award-winning prop firm, Fidelcrest. All right, folks, here we are on Trading Nut. We've got Raphael Kimmel back in the house. We did an awesome podcast, a link below the video here. Go and check it out after watching this, where he's going to break down what I suppose is the outcome of him learning the free ICT content on the YouTube channel that he put out there, and his other smart money knowledge, as well as his price action knowledge, I'm assuming is still in there as well. So welcome back to the show, Raphael.
Thank you for having me on, and let's get to it.
Fidelcrest is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So what sets Fidelcrest apart? Well, it's their verification stage payouts of up to $30K in as little as 15 days. So you can receive your first payout prior to becoming a fully funded trader. Just complete the challenge phase and verification stage without violating any rules to receive your first payout. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more.
Okay, so when we're talking about ICT, he puts a big emphasis on starting from the weekly, daily, and forecasting what the daily and weekly expansion might be. So for example, right here on the daily, I was expecting this high to go. So I was expecting this high to break, to be used as liquidity, to then either break lower or just find then a new high. So what I was expecting in this day, and I even put this magnet on here, was that this was going to be the draw that price would have. So price would gravitate towards this zone. Why? Because you have on the weekly, you have this supply zone right here. So you can just put this supply zone. This is what I was seeing on the weekly too. This supply zone had the daily fair value gap that was right here. Now, I didn't give that much importance to the fair value gap because I was like, it's just such an old one that there's no need to be giving it that much emphasis, but it actually respected it beautifully. So this barely didn't touch it, just touched the weekly, but then this tapped it and went down. So my forecast in the morning was, okay, we are right. Let me see the daily break. So the day started off here. The week. And I was like, okay, I expect this high to go, and I expect then the lows to go too. The lows haven't broken yet for people that are watching. Like today is the 1st of December, and the lows haven't gone. So we came down and came back up. But my idea was, okay, there's buy-side liquidity right here. There's sell-side liquidity right here. So I forecast that price will sweep these highs and then give us the move down. So what I want is I want to wait for this sweep and then enter short. So what I do, I go back to the 15 minutes and I see price moving quite quickly into the buy-side liquidity that I talked about. And I was like, okay, this is clear manipulation. So price went very quickly, and I was simply like, okay, I wasn't expecting it to be this quick, but it was. So we'll just react from there. So I waited for price to actually change bearish. This was something that I learned from Omar, because I was constantly entering in these trades right here, where price does this ascending channel. So move up, move down, move up, and then breaks. And then you have this 15-minute fair value gap right here. So this was the first zone I was looking for a trade on. But I didn't want to set a limit on the 15-minute because the break was not very clean. Because you can see, okay, we broke, but we left the big wick. So I was like, okay, I want a confirmation entry, meaning I want price to switch bearish after this. So price is bearish right here, but then it switches bullish as it's approaching the fair value gap. The thing is that when we are bullish like this is just building liquidity for price to then impulse down. And that's exactly what happened. Price impulse down yet again, formed another fair value gap. So I decided to enter. And actually the risk to reward tool, if I would have entered here, the risk to reward, if I would have entered here with a 21, 22 pip stop, would have been basically the same as me entering here with a 15 pip. So price switches bearish again. Good market displacement. I was looking for a trade right after this break lower, actually. That's why you see this trend line right here. But it actually broke a solid bit lower. Now people might ask, okay, why did you not choose this fair value gap right here? The reason for that is because I want to enter when price is on a premium. When I'm entering short, I want to enter when price is on a premium. So I put the Fibonacci here, 50%. So I want to enter above the 50%. This was the possible fair value gap. Set the entry. Boom, I get tagged in. And then I want the lowest hanging fruit take profit. This basically guarantees that I have a higher risk to reward, but I also have that I have a higher strike rate, but I have a lower risk to reward. And we'll see that happening right now where price taps it beautifully. I think it still gives me a little bit of drawdown, and then it starts moving in my direction. Right here, I don't move the trade yet to break even. I may reduce the risk a little bit just to something like I remove 50% of the risk by reducing the stop loss. Maybe to here, something like this, just to be protected that if price wants to sweep this liquidity again and move lower, I'm still inside the trade. Price then continues moving down and eventually it hits my take profit for a 2.72% trade. Now, what do I mean with lowest hanging fruit take profit? Well, we have this swing right here on the 15 minute. We have price going from here to here very impulsively. So I want to see where's discount, because the algorithms, after it moves up so much, it wants to rebalance. And where does it rebalance to? To the next pocket of liquidity, at least in discount. Because if it's going to go back up to rebalance, actually, it has to come back to the EQ at least before it moves up. So what I look for is I look for EQ, which is the 50% line, and what's the liquidity that lays below it. So you come to the 5 minute and you can see, okay, EQ right here, there's a swing low right here, and this was my exact take profit. Because I was like, okay, it's quick trade, 1 to 3 almost, so I'm happy with the trade. What happens? Price actually goes ahead and it continues moving lower and lower, and it would have been like a 10% trade, I think. But personally, I asked myself, how would I feel if I didn't stick to my plan right here and taking profits here, and this would have reversed? I would have not felt good. So I'm happy with this. Could it have been more? Yeah, 8% because it would have swept the Asia lows, but woulda, coulda, shoulda. Think about probabilities and long term. So that's what I look for in a trade. I look for a sweep of the highs, which we got here on the daily, weekly basically, and a mitigation of a fair value gap. Then you have, so what I look for, liquidation, ascending channel, market displacement. So market break to now switch bearish, switch in my direction, fair value gap, and then that's where I set my entry. Those are the 4 or 5 things that I look for. If I get those, I execute. If I don't, then it's fine. But yeah, this was the breakdown of a.
That's fantastic breakdown. Now, did you move the stop to break even at some point in this trade?
I did after. Yeah, that's a good question. I did after we broke this low right here, because now I'm thinking if it breaks above this high and this high, then this is probably going to go after. So I would rather set my stop loss to break even after structure breaks. And if it switches now, what does it do? It's probably switching bullish. So I want to move my stop loss as to where it would invalidate my trade if it hits that stop loss. The same thing here. This is something that people really need to understand. And I know this should be a little bit quicker, but your stop loss should be where your trade would be invalidated if price reaches it. So price could have come all the way up to here to mitigate this supply that's right here before moving lower, because my stop loss was above it. I wouldn't mind if price would have come to here because I would have still been in the trade. But what if I try to squeeze it? If I'm like, oh, if I just cover the fair value gap, then this would have been a 1 to 7. Okay, what about the times that this comes, mitigates this supply, and then moves lower? Then you're out of the trade. So this is, if you guys check the interview, this is what I talked about, the trifecta of trading: strike rate, frequency of trades, and risk to reward.
Hey folks, ever wonder what broker I use? Well, I use Hanko Trade. It was a no-brainer because I was looking for a broker with good trading conditions and one that wouldn't restrict my leverage. Now, by joining Hanko Trade, I've also cut down my trading costs significantly with their super low commission of just $1 per 100K. You can learn more at hankotrade.com or just click the link I've put in the description. Look, that was a brilliant breakdown, probably one of the best ones on the channel I've seen. So thank you very much for coming on and sharing that with us. Now, do you want to wrap up by letting the guys know how they can get hold of you?
Yeah, so if you guys want to check out, I have a YouTube channel too. I have Twitter, which is @KimmelTrading, both of them. And I also have an Instagram, even though I don't really use it, but you can follow me on there.
Awesome. Look, guys, we did do a podcast as mentioned. Check it out. Link below this video. While you're clicking around down there, hit subscribe, hit like, click that notifications bell, click all, and we'll see you in the next video.